Assalamu alaikum. I am Aisha Ashraf, Assistant Professor, School of Business from Asian University of Bangladesh. Today, I will discuss financial statement analysis. What is financial statement? Financial statement that summarize financial information to the users, that summarize the firm's financial information, that evaluate firm's financial condition also. So, in this chapter will be discussed. Number one is what are the financial statements. Number two, a possible framework for analysis. Number three, ratio analysis. Number four, trend analysis. Number five, common size and index analysis. Now, there are the examples of external users of statement analysis. First of all, I have said that financial statement that summarize information and that provide information to the users. And there are two types of users. Number one is external users. Number two, internal users. So trade creditors, trade creditors are the external user. They need to know about the firm's condition, firm's position. So they must focus on the liquidity of the firm. So that's why trade creditors need to summarize the firm's financial information and affairs. Number two, bondholders. Bondholders are the second external users who focus on the long-term cash flows of the firm because they want to know the ability of the firm or the creditability of the firm that can pay the long-term loan or not. Number three is shareholders. Shareholders are also the external users who focus on the profitability and long-term health of the firm because that they want to know the firm's ability to earn return or to earn net income. Now the examples of internal users of statement analysis. In internal users, we can find out that the first thing is plan that focuses on assessing the current financial position, evaluating potential firms' opportunities. Because a firm needs to make a plan, and that plan must be focused on the current position and potential opportunities also. So they need to know the firm's financial information or firm's financial condition. Number two, control. If a manager wants to control the firm, then he or she has to know the firm's financial various assets, asset efficiency, because then he or she can easily control that. So number two is control that focus on return on investment for various assets and asset efficiency. Number three, understand. That focus on understanding how suppliers of firms analyze the firm, because the suppliers must supply the materials and they want to know the firm's condition also. So they need to know the firm's condition. Primary types of financial statement. Number one is balance sheet. The balance sheet is what? A summary of a firm's financial position on a given debt that shows total assets equal to total liabilities plus owner's equity. We know that is the golden rule of accounting. A for total assets equal to total liabilities plus owner's equity. That means total assets should be equal to total liabilities. And here we can see, we can say that a balance sheet is a financial snapshot at a single period of time. That means it's given a snapshot of total assets and total liabilities. So, income statement, a summary of a firm's revenue and expenses of a specified period ending within net income or loss for the period. So what we can say, we can say that income statement must emphasize on revenue and expense over a specified period, and that we can find out the net income or net loss. So here is the example of balance sheet asset side. You can see in balance sheet there are two sides. One side is asset side and another side is liability side. So what are the items that we can get in asset side? In asset side we can get cash and cash equivalent, that is $90. Accounts receivable, $394. Inventories, $696. Prepaid expense, 5, and accrued tax prepaid, advanced tax prepaid is $10. So that total current asset is 1,195. So what is current asset? Current asset means the asset whose maturity is less than 1 year. So that these are the assets whose maturity are less than 1 year. Now, the fixed asset. In fixed assets, there are two portions. Number one is tangible asset that can be seen or that can be touched. And number two is intangible fixed asset that cannot be touched. So in fixed asset, we must deduct accumulated depreciation. Then we get net fixed asset. So after that, we add investment, that is long-term must be, and other asset also. So that you can see there are the assets. Total asset is 2,169, and that are the combination of current asset, fixed asset, investment, and other asset. So this balance sheet answers how the firm stands on a specific date. Number 2, what PW owned. Number 3, amounts owned by customers, future expense items already paid, cash or cash likely convertible to cash within 1 year, original amount paid, and account deductions for wear and tear. Now we are going to discuss the liability side in balance sheet. In balance sheet, you can see there are two portions. Number 1 portion is current liabilities, long-term debt, and total equity. These are the main 3 items that is added to get to the liabilities and equity. So first of all, I am discussing the current liabilities. In current liabilities, you can get notes payable, accounts payable, accrued tax, and other accrued liabilities. That are the combination of current liabilities. So what is current liability? Current liability means that liability must be repaid within 1 year. And shareholders' equity. Shareholders' equity is the, and after adding current liabilities, we can get the long-term debt. What is long-term debt? The long-term debt is an instrument that firm issue to get loan. And after a maturity, the firm must to repay interest and total principal. And shareholders' equity. Shareholders' equity, what are the items that combine shareholders' equity? Number 1, common stock. Number 2, paid up capital and retained earnings. These are the main items that combine shareholders' equity. So the 3 items are added to get the total liabilities. Number 1 is current liability. Number 2, long-term debt. Number 3, total equity. So what are the results that can be found out? Number 1, notes assets equal to liabilities plus equity. Number 2, what BW owed and ownership position. C, owed to suppliers for goods and suppliers, unpaid wages. And debts payable, that's maturity is less than 1 year, and that's maturity is more than 1 year also. So original investment and earnings investment. Now we are going to show the income statement. You can see that basket owner's statement of earnings. Here is net sales, deducting the cost of goods sold, then we can get gross profit. From gross profit, we deduct selling and administrative expense, then we can get EBIT, earning before and interest and tax. And from EBIT, if we deduct interest expense, then we can get EBT, earning before tax. And from EBT, if we deduct income tax, then we get earning after tax, EAT, or net income. So from net income, we deduct the cash dividend, and after that we get retained earnings. So what are the things that can be found out in income statement? Number 1, measures profitability over a time period. Number 2, receipt or receivable from customers. Number 3, selling expense, administrative expense, office supplies expense. Number 3, operating income. Number D, E, cost of borrowed funds. F is taxable income, and the last one is amount earned for shareholders. So this is the framework for financial analysis. What is financial analysis? When we analyze the financial statement to get a result, or when we analyze firm's financial statement for interpretation or for analyzing, then that is called financial analysis. So in financial analysis, there are two types of analysis. Number one is trend analysis, and number two is analytical tools that used. So what is trend analysis or seasonal component? How much funding will be required in the future? Is there a seasonal component? That is measured in trend analysis. In analytical tool use, so there are different types of tools used to measure the trend analysis. Number one is sources and uses statement. Sources and uses statement of cash flows. And number three is cash budget. Analysis of the firm's needs of the firm. Number two, analysis of the financial condition and profitability of the firm. So these are the two things that is analysis. So in analysis, we can get the health of the firm. Okay, we know what is the firm's health condition, and that can be evaluated by financial ratios. And in financial ratios, you can measure individually, over time, in combination, and in comparison. In financial ratios, we analyze the business firm risk also. Okay, so there are two types of risk that can be measured for risk analysis. Number one is business risk, number two is financial risk. And what is business risk? Business risk is that relates to the operating of the firm, and financial risk is relates to the credibility of the firm. Okay, number one, business risk. Business risk relates to the risk inherent in the operations of the firm, and these are the example. If firm sales is more volatile or cost is more volatile, that is ups and down, and proximity to break-even point, then that is the example of business risk. Framework for financial analysis. Analysis of the firm needs of analysis of the firm. A financial manager must consider all three things jointly when determining the financing needs of the firm. So, what are the three things that firms determining? Number one, analysis of the firm's needs of the firm. Number two, analysis of the financial condition and profitability of the firm. Number three, analysis of the business risk of the firm. So that determining the financing needs of the firm. So the use of financial ratios. A financial ratio is an index that relates two accounting numbers and is obtained by dividing one number by the other number. So a ratio is a tool that analyzes the firm's financial condition and performance, we can say. And it is the tool that divide one item by another item. And types of comparison. There are two comparison, internal comparison and external comparison. Internal comparison means that we need to compare for within the company, and external comparison means we need to compare from external. So external comparison and sources of industry ratios. This involves comparing the ratios of one firm with those of similar firms or with industry average. And similarity is important as one would compare apples to apples. So you can easily say that when firm compare these firms' financial ratios with industry average, then that is called cross-sectional analysis, or we can say that external comparison. First of all, we are going to discuss the liquidity ratios. In liquidity ratios, that shows the firm's ability to cover its current liabilities with its current assets. That is called liquidity ratio. In liquidity ratio, there are many types of ratios. The first one, which is very much important to measure the liquidity, is current ratio. So what is current ratio? Current ratio means current assets divided current liabilities. So where we can get the current assets and current liabilities, we have already shown you that current assets are the combination of cash, accounts receivable, inventory, accrued income, and advance expenditure. And these items are added. To upper side. And current liabilities are what? Current liabilities are accounts payable, notes payable, in accrued expense, and advance income. So these are the items combination that go to the lower side. So then we can get the current ratio is 2.39. So what is 2.39 and how it can interpret? 2.39 interpret that we have ability to pay 2.39 times of current assets to cover the current liabilities. That is 1 unit. So these are the trend analysis. You can see in 2001, the current ratio was, BW current ratio was 1.91. In 2002, that was 2.26. In 2003, that is 2.39. So you can see that there is a trend for increasing trend. So that is increasing year by year. Industry analysis, and there is the industry average. You can compare that in 2001 to industry average. In trend analysis, you can see 2001 to 2000 industry average. In 2001, that is 1.91, and an industry average is 2.01. In 2002, that is 2.26, and industry average is 2.09. In 2003, our company's current ratio is 2.39, and industry average is 2.15. So in last year, you can focus. Our company's current ratio is more than industry average. And what it interpret? Our company's liquidity position is in satisfactory position. So in liquidity ratio, there is another ratio is acid test ratio. So acid test ratio, how we can find out acid test ratios? The current asset minus inventory minus prepaid expense divided current liabilities, then we can get acid test ratios. So how acid test ratio measure? Acid test ratio measure how much quick assets available now to pay current obligation now. So that's why we deduct quick assets divided quick liabilities, and the result is 1. And what it interpret? It interpret that we have ability to pay. We have 1 times quick assets now to pay our current liabilities. So this is the acid test ratios trend analysis and cross-section analysis. In 2001 to 2003, you can see that quick ratio first year is 1.11, and second year is 1.04, and in third year it is 1.00. So comparing the trend analysis, it is a little bit fluctuating, little bit decreasing trend. Okay, and in the compared to cross-section analysis, you can say that in recent year 2003, our company's quick ratio is 1, and whereas the industry average is 1.25. So compared to industry average, our company's quick ratio is lower. That indicates that we have little bit liquidity satisfactory compared to industry average. So ratio is weaker than the industry average. So this is the summary of the liquidity current ratio comparisons. This is the recent year comparison. This is the current ratio and acid test ratio. Number 1, strong current ratio and weak acid test ratio indicates the potential problem in the inventories account. And note that this industry has a relatively high level of inventories. So that is the graph. You can easily plot. So current ratio is horizontal side, and in vertical side the year. So you can get from 2001 to 2003, and you can see that our company's current ratio is in color blue and the industry average is in color red. So you can see that current ratio is in increasing trend, and whereas the industry is constant or fluctuate. Asset test ratio or quick ratio. Here is the current ratio, quick ratio is in decreasing trend, and on the other hand that in industry you can see that it is also decreasing trend. So what is the interpretation? The current ratio for BW has been raising, at the same time the asset test ratio has been declining. It can be happen. Number two, the current ratio for the industry has been rising slowly at the same time, whereas the asset test ratio has been relatively stable. That indicates that inventories are a significant problem for our company, that means BW. And this is the financial leverage ratio. Financial leverage ratio is the first ratio measure debt to equity ratio. If this ratio is higher, then we can say that our risk is also higher. How we can calculate debt to equity ratio? Total debt is total debt divided to shareholders equity. So what is total debt? Total debt is long-term debt, and shareholders equity is the combination of common stock, preferred stock, paid up capital, and retained earnings. So now we are putting the value and get total debt to equity ratio is 0.90. That means our 100% equity, there is 0.90 debt. So that is risky. It shows that how much extent of firm's capital is financed by debt. That is emphasize that 90% capital are invested by debt. So there is the trend analysis and cross-section analysis. In 2001 to 2003, we can say that our company's debt to equity ratio is 0.81, second year is 0.88, and the third year is 0.90. So our company's debt to equity ratio is in increasing year by year. So the risk is also increasing. And the industry average, you can see that in industry average, the debt to equity ratio is 0.90, and our company is also 0.90. So that is stable. That compared to our debt to equity ratio is quite good, because industry average and our company's debt to equity ratio is same. Number two, that measure the financial leverage ratios or financial risk ratios is debt to total assets, total debt divided by total assets. So we know that total debt is long-term debt and total asset is the total amount of assets. That measure how in our total asset, what are the extent of debt. So that is 4.47. It shows the percentage of the firm's assets that are financed by debt financing. So in 100% asset financing, 47% are financed by debt. So that is lower. So that is in trend analysis. You can see that in 2001 to 2002-3, our BW company's debt to total asset ratio is in increasing trend, and in industry average is quite stable. Number three is the capitalization ratio. So what is capitalization? Capitalization, these are the two items combination, long-term debt plus equity, that we can get total capitalization. So total debt divided total capitalization, then we can get 0.62. It shows the relative importance of long-term debt to the long-term financing of the firm. Total capitalization ratio, you can see it from 2001 to 2003, it is in increasing trend. It is in decreasing trend. First year it was 0.67, 0.62, and 0.62. And compared to industry average, it is quite higher. Okay, it shows the relative importance of long-term debt to the long-term financing of the firm, and it shows outer liability is higher or firm's capital is higher, and it shows that outer liability is higher. So now we are going to discuss the time interest earn ratio, that is interest coverage ratio. And interest coverage ratio can be calculated EBIT divided interest expense. And our company's EBIT is $210, and interest expense or interest charges is $59. So we can get our time interest earn ratio is 3.56. That indicate that how much firm's ability to pay interest expense against of loan. So that higher the ratio, that indicate lower the ratio, lower the risk. If this ratio is higher, then risk will be also lower. So you can see that BW companies in first year that the time interest earn ratio is 10.30. So its interest coverage is more better than now. And in compared to cross-section analysis, you can see that industry average that was 5.19, that is standard interest coverage ratio, and our company's that is BW is 3.56, that is quite lower. Here is the graph. You can see we can plot the graph. So the trend analysis of interest coverage ratio, that is in blue color. You can see that from first year to second year, it is in highly falling, and after that it is in decreasing trend. So the summary of the coverage trend analysis, the interest coverage ratio for BW has been falling since 2001. It has been below industry average for the past 2 years, and that indicates that low earnings may be a potential problem for BW. And note that we know that debt levels are in line with the industry average. So in activity ratio, the first ratio is receivables turnover. And receivables turnovers can we get annual net credit sales divided receivables. So our annual credit sales divided receivables, then that get 5.61. That measure how many times in a year that our receivables that we can get from our debtors. So that indicate that 5.61 times. And that indicates quality of receivables and how successful the firm is in collections. That means our firm collect from receivables 5.61 times. And if we convert it into days, then we can get average collection period equal to days in the year, that is 360 days or 365 days divided receivables turnover. Then we can get 365 divided 5.61, so we can get 65 days. So that indicate that after 65 days later, we can get from our debtors. So average number of days that receivables are outstanding. And this is the trend analysis. You can see that from 2001 to 2003, it is in decreasing. So our average collection period is decreasing. That is quite good for our company. And industry average, from comparing to industry average, it is stable. And that is payables turnover. Second one is activity ratio. Annual credit purchase divided by accounts payable. Annual credit purchase is 1,551 divided 94. So we can get 16.5 times. That indicates that our payment times in a year is 16 times. That indicates the promptness of the payment to suppliers by the firm and also the financial soundness of the firm. So if we convert the days, then we can get days in the year, that is 360 or 365 days divided by payables turnover. 365 divided by 16.5, then we can get 22.1 days. So the average number of days that our payables are outstanding. And this is the trend analysis. You can see that our payables turnover ratio is in first year is 43.5 days, and in third year that is 22.1 days. That is decreasing. That means our financial soundness is quite good. Quite good. So inventory turnover. Inventory turnover ratio is the cost of goods sold divided average inventory. Cost of goods sold is how we can get cost of goods sold. Cost of goods sold is the company's purchase plus other expense related with manufacturing. That is cost of goods sold, and that indicate how many times need to process our inventory in a year. Okay, so that is the result is 2.30 times. That means in a year, 2.3 times needed to convert our raw materials into finished goods. And that indicates the effectiveness of the inventory management practice of a firm. So in activity ratio, the trend, you can see the trend analysis in 2001 to 2003. You can see that our inventory turnover ratio is 2.64, and that is in decreasing trend. That means the PW has a very poor inventory turnover ratio. And this is the graph. You can see that BW companies inventory turnover ratio is lower than the industry average. Total asset activity ratio, total asset turnover is the most important ratio. You can see that net sales divided total assets. So that indicates the overall effectiveness of the firm in utilizing its assets to generate sales. So putting the value, we can get the 1.02 times. Lower the total asset turnover, then we have indicate that we have many assets or excess assets. And here is the trend analysis. In trend analysis from 2001 to 2003, that was 1.01, and in last year that was 1.02. So BW has a weak total asset turnover ratio year by year, and comparing the industry average, it is also lower. Is this ratio considered weak? No. When total turnover is lower than the industry average, that is bad. But when in trend analysis, our company's total turnover ratio is decreasing trend, that indicates that we have excess assets. So the profitability ratio, number one is gross profit margin. Gross profit divided net sales. How we can find out gross profit? When sales revenue deduct cost of goods sold, then we get gross profit. So gross profit divided net sales, that is 0.277. That indicates that our company's gross profit margin is 27.7%. That indicates that we have not sufficient amount of profitability. Indicates the efficiency of the operation and firm's policies also. So here are the gross profit margins trend analysis from 2001 to 2003. Our gross profit margin ratio is in decreasing trend. Our profit is decreasing trend. So that's not good for company. And compared to industry average, our company's gross profit margin is also lower. Here is the graph, you can see, and the net profit margin. The last one is net profit margin. The net profit margin is net profit after tax divided net sales. So how we can get a net profit margin? Net profit after tax divided by net sales. So that is 0.041. That indicates that we have only 4.1% net profit margin. That is too much lower. So our company's profitability is not in good position. So that's all for me. Thank you so much.